Good afternoon, everybody. What's going on? What's up, Craig?
What's up, B-Red?
All right, so we're like 3 Wednesdays deep right now with our Facebook Live, and
Is
uh,
it 3 or 4?
maybe this is our fourth week. I don't know. We're on a roll here. But as you guys know, we're doing this just to provide tips and just helpful advice based on our experience, things that we're seeing in our business every day, and just common things that we're discussing with our clients, and we're trying to help and share these ideas with you guys. So um, today, the purpose of our live event is to talk about refinances. Craig, you do most of our consultations, so I mean, I think you'll be the first to admit we've done a lot of refinances over the last 2 years.
I think that's most banks are doing a lot of refinance applications, and mainly because interest rates have dropped significantly since COVID, the pandemic. So, a lot of that is sparked by getting lower monthly payments. But and the main reason and goal of this live chat is to talk about what are some of the reasons that you would refinance. Why is it a good time to refinance? What determines your interest rate? How do you know if refinancing is best for you? And then talk a little bit about our process and how we can determine whether there's a benefit to refinance. Is there an objective behind you refinancing?
Yeah. So, what I mean, why don't we talk about the different reasons? Let's start just by talking about the different reasons to refinance. And I'll just start by saying the most common is your rate and term refinance, right? One, you're refinancing for the purpose of lowering your rate, or you're refinancing, or there's an and, or you're refinancing for the purpose of changing your term. Maybe you want to re-amortize it over a longer period because now you're getting a lower rate and you're stretching your principal out. So you're going to get a combined savings from doing that. But also, some might refinance to a lower term because they see the benefit in having I guess, lesser time to pay that mortgage, and the lower rate and paying the interest on the mortgage for a lesser time is also going to save them money as well. So, um, I mean, that's first and foremost. Is there anything you want to mention about the rate and term? You're doing a lot of them.
Yeah, I mean, I think in general, the idea behind a longer amortized loan, a 30-year loan is the most common loan, is that if you're paying we're borrowing money at a certain interest rate over 30 years, it's going to cost you more money than if you're paying a loan off in a shorter period of time in general. And most people, when we talk about rate and term, it's mortgage lingo. Most people don't know what the general public doesn't know what a rate and term refinance definition is. And simply all it means is that you're paying off the current mortgage balance and any settlement fees, and that is all, right? So you're either changing your rate to benefit you, or you're changing your term and or rate to benefit you. So that's the basics of it. But we're seeing a lot more rate and term refinances because people can save a lot of money in interest by lowering their term over a set amount of time. Or some people might want to lower their monthly obligations, and going up in term might help increase some cash flow, right? I mean, it's some people are going through some difficult times, so not only lowering your interest rate but saving some cash flow monthly might help reduce some stress in your life as far as obligations are concerned.
Yeah, and I think it's also makes sense to be conscious of that going up in term. A lot of people don't think about that. They're looking at, okay, I'm saving money and interest. My interest rate is lower, but in reality, you might be extending the amount of time that you're paying your interest. So over the life of the loan, you might end up paying more interest by spreading it out over that 30 years. So just be conscious of that, right? I think that's an important thing to know, right? Some people are taking their loan for maybe 20 years left to pay on it back up to a 30-year loan because they don't realize, like, they think that there's only a 15 and a 30-year option, and the 15 they think might be more of, it might increase their payment, but there are other options where you could do a 20-year mortgage and kind of like reduce your rate, but keep the amount of years that are left to pay on the loan almost the same as what the current loan has you amortized at.
Yeah, and to even add to that point, a lot of people don't realize too that just because you go higher in term doesn't mean that you don't have the ability to pay your loan off sooner, right? We've have done several reports to show people that even going up in term and saving in interest, you can take savings that you make monthly and apply that towards the principal of your loan, directly offsetting the amount of years that you have to pay, right? If I pay an additional $200 a month in principal on a 30-year fixed, it's going to be paid sooner than a 30-year term. And what I mean by principal is you're paying additional money on top of what your minimum required payment is, right?
Yep. So why don't we talk about debt consolidation? Because rate and term, I mean, a lot of people are aware that you can lower your rate just for the purpose, refinancing just for the purpose of doing that, cutting your mortgage payment down or cutting the years left to pay on your loan down. Another great reason to refinance is for debt consolidation, using the equity in your house. I mean, I think there's a fair share of people taking advantage of that type of refinance right now because the rates are so low and the equity positions that they have changed drastically over the last year or so because of increased values.
Right. So I think that debt consolidation is a very common loan. Debt consolidation and other types of what we call cash out refinances are common to use the equity to your advantage to pay off debt to reduce obligations. Is sometimes really beneficial to people. I mean, high interest rate credit cards, what it could be, a car loan that you want to pay off. It could be business loan. It could be high interest rate student loans. So there's a variety of purposes behind a debt consolidation loan that would be very helpful to somebody. But in terms of how a bank looks at it, a debt consolidation loan is considered a cash out refinance. So a cash out refinance just means that you're paying off your mortgage, settlement fees, and any other additional money that's being used would be used to either consolidate debt or for other reasons, right? And we talk about those, we can talk about those other reasons that you might take cash out, so to speak.
Yeah, I think there's a lot of reasons, right? So the debt consolidation itself, you're taking cash out to consolidate higher interest debt to reduce your overall monthly payments. In some cases, you can go down in term, so you can take your 20 years that's left on the mortgage or 25 years that's left on the mortgage. And by doing a cash out refinance and paying off higher interest debt, it allows you to afford to take that to pay those things off, but also take that mortgage down to maybe a 15-year loan, because the new 15-year loan that you have is less than your current mortgage or previous mortgage at that point, plus all of those monthly expenditures that you just got rid of. So that's another good thing, is that you can do a cash out refinance if you have enough equity to pay off all those higher interest debt and also still lower the amount of time left to pay on your mortgage. So you're kind of killing two birds with one stone.
Yeah. And I mean, I think sometimes it's not just looking at the debt that you're paying off. It's kind of outlining how long would it normally take you to pay off that debt at the current income level that you have, right? You only have so much additional net disposable income to use to pay off additional money towards higher interest rate credit cards. Sometimes people just pay the minimum payments each month, right? But it might take you 10 to 15 years to pay off a debt that, if you're just paying the minimum payment. Most people, I would say, that that have minimum payments, they try to pay more than the minimum payment. But it's kind of understanding your game plan. Understanding how long is it going to take you to pay off that debt? And sometimes a cash out debt consolidation loan is really impactful. Like if I'm saving $500 a month in obligations between, credit cards or, whatever loans that you're consolidating with a new mortgage, and I take that additional money and use it elsewhere, not only, you might be able to invest that money. You might be able to apply that directly towards the principal of your current mortgage or a new mortgage. I feel like they're very good loans, and there's always a way for us to come up with a game plan for you specifically, whoever you are that is out there listening, to find out whether a debt consolidation is right for you.
Yeah. So we don't spend too much time on this. We're talking about the cash out refinance overall. So one reason people use a cash out refinance is obviously to consolidate debt, to pay off their existing mortgage and some other loans or credit cards that they have outstanding. There's other reasons that they can use a cash out refinance, right? One is for investment purposes, right? So they can pull money out, equity out of their house and use that money to make your traditional investments, like maybe putting some money into an IRA or buying some stocks, some bonds, some, I don't know, Bitcoin, if they're into that, or whatever the case is. You can also use the equity that you're pulling out of your house to buy other real estate investments. Maybe you want to buy a house down the shore, right? It's a great opportunity. If you have equity in your house, you could take out enough to make a 10% down payment on a second home, right? Because like I was talking to somebody yesterday, buying a home in the Poconos, right? You can get a home in the Poconos for maybe, I don't know, 250 grand, let's call it. You know, it's not going to be a mansion, but it's going to be decent, right? Something that you can rent out. You can, go there a couple weeks out of the year and use it for personal reasons, but you can also earn and create a rental roll off of that property that's going to help pay the mortgage, right? Well, on a $250,000 house in the Poconos, in this example, you need 25 grand down. So you could do a cash out refinance, pay off your existing mortgage, get a new mortgage, and get $25,000 out, assuming you have the right equity position, which we're going to help determine that, right? So that's another reason you can use a cash out refinance, is to buy a second home or an investment property. And the third, might be for investment purposes, might be to fund a business. Maybe you have a business venture that you want to, move into, and that could help fund that idea, So those are some great ways you can use the equity for investment purposes. There's a few other things, personal reasons and making renovations. You can use, like a lot of people with the current housing market, the thought of selling the house to buy a house at these higher prices, it might be more beneficial to kind of lock in a low interest rate and use the equity in your home, to maybe build that home office or build the deck out back or put a pool in. So, you can use the equity for many different reasons. Did I leave anything out there, Craig? You think I missed anything?
No, but I think that, with regards to home renovations, sometimes, people, are looking for other ways of financing instead of refinancing their existing home. But for the most part, money is cheaper in the mortgage industry than most other avenues of financing. Like if you go directly to a finance company related to pools, I can almost guarantee you that interest rate is going to be way higher than if you're talking about getting a mortgage, or if you're talking about, financing a roof. Company might have higher financing terms, or even other non-traditional types of financing like personal loans. Those rates are extremely high, right? Comparatively speaking to a mortgage. And just like you said with the rate and term concept, knocking two birds out with one stone, it's like if you can get a lower rate than where you're currently at, plus get additional money that's cheaper than other avenues of financing, it's a win-win situation.
Yeah. Plus, I mean, not only that, you have a longer term too, right? So you could almost borrow the money to make the renovations and do it at a 30-year loan, because maybe the 30-year loan works best for your financial situation. But with getting maybe a pool loan, they might only have 5-year terms. And I don't know, I don't work for a pool company, so I could be wrong with the exact amount of years, but I'm inclined to believe that like a 30-year mortgage is going to be longer than any other term you're going to be offered for any other different type of private financing or personal loan.
Agreed.
So yeah, there's a lot of reasons to do cash out. I don't want to forget, you can also do a cash out refinance if you want to splurge on a European vacation. We went to Greece a couple years ago. It was amazing. I don't think it's a great financial investment, but the purpose is if you have the equity, it's a great time to use it if you need, right? I don't know that I would do the vacation thing. No, I'm just joking with that. But in all seriousness, you can use it for whatever you need to. So now that we've established the different reasons one would refinance, let's talk about why today is important. And Kristen, yes, we can go back. I don't know if I want to refinance to go back to Greece. Kristen's over there in that gallery. She definitely wants to go back to Greece.
Of course she does.
Company trip.
Yep.
So let's talk about why it's a good time to refinance now. I mean, I think the writing's on the wall, right? Interest rates and equity.
Yeah, and values are going up, which means that you're able to pull out more cash if needed. Equity position also affects interest rate, right? A lot of like a conventional loan is very important if you have, very good credit and your equity position is greater than what it was a year ago. That might affect your interest rate for the better, right? Interest rates have been low since, I would say March of 2020, but they're not always going to stay this way, right? I feel like a lot of times you're hoping that things are going to get better than they actually are. And a lot of people are on the fence about refinancing. And to me, we've seen a little bump in interest rates probably since December in general of 2020. But to keep it in perspective, rates are at an all-time low since since mortgages have been available to the public. So it's still a really good time to look at it, even if interest rates aren't at the best level as they were in December. But yeah, equity position and interest rates play a big part in why it's important to look at refinancing now, because refinancing a year from now, values might not change a lot, but your interest rate going up 1% could mean the difference of you wanting to pull out cash or not pulling out cash or changing your rate and term. So, the good thing is that it's not hard to find out whether there's some type of benefit, and we do a good job at analyzing whether or not it makes sense for you financially.
Yeah, 100%, man. So I wanted to add something. I can't think of what I was going to say though. But either way, moving on. Equity position and interest rates. Fear of missing out. That's what I was going to say. I know that people we speak to right now have that fear of missing out, or that they already missed out because they didn't take advantage when rates were at their lowest level. But right now, the rates aren't really far off from that, right? So the last thing you want to do is be in this position next year where you wish you had refinanced and it doesn't make sense anymore because you're in the fours, or the fives, or whatever the rates are going to do, which we can only speculate, but I'm more inclined to believe they're going to go up rather than down. So if you haven't done anything yet and you're thinking about it, now's the time to at least inquire to see if it makes sense for you. So moving on, I think I did get this question a lot. You get this question very often, Craig, is rate. Everybody is, what's my rate? Why don't we touch on that first? Let's talk about what determines an interest rate.
I think every program is different. The good thing is that there's only so many programs that are mainly offered to the public. Your qualified mortgage products, conventional, VA, USDA, and FHA. The most common loan refinances are with not USDA, conventional and FHA. So, and we have been getting a lot of VA loans, but interest rate is more affected with certain loans than other loans based on credit and equity position. I think credit score is the most important factor, right? Having a higher credit score is going to put you in the best position for an interest rate. And, just to give you an idea, in the mortgage world, having a 740 plus middle FICO score is most likely going to get you the best position in the credit or as far as interest rates are concerned for a mortgage. So, if you're lower than that, doesn't mean that you can't get financing. It just might not be your interest rate might not be as good as somebody that has a 740 credit score. I don't know if you want to touch base, Brad, on maybe conventional. How does that work differently than maybe other types of loans?
Yeah, I mean, I think all the government programs. I always tell people it's either you qualify or you don't. You're going to see a slight change in interest rate, having a 740 opposed to a 680 or a 640 for that matter when you're talking FHA or VA. But you're going to see bigger differences on a conventional loan because conventionals have a lot of loan level pricing adjustments, which all that means loan level pricing adjustments are risk-based adjusters. So based on the risk of the type of loan, it's going to determine the interest rate. So if they're doing a cash out refinances versus a rate and term, or if you're buying an investment property versus a primary, or, those things have more risk. It's more riskier to finance an investment property for a lender than it is a primary. So that's going to result in a slightly higher interest rate. And then when you, like you said, the credit scores, big impact on conventional loans. So you're going to see a big difference in rate from a 740 to a 680 or a 640, right? The other thing is with conventional loans, I guess, I'm trying to think if I'm missing anything.
The cash out, right? The cash out component. I don't know if you, I didn't know if you said that, but cash out component is if you're taking cash out of your property, it usually is going to have a higher loan level adjustment versus a rate and term refinance, right? So if you're just paying, changing your rate from a 30-year to a 30-year fixed rate to a lower 30-year fixed rate, it's different than taking cash out. That interest rate is usually going to be high, right? Or, sometimes going to a lower term, it changes your interest rate for the better, right? Because some of those loan level adjustments for pricing don't exist on a 15-year versus a 30-year. So, but the good thing is that you don't need to know all that when determining, whether this is a good move. We do all that for you. We price out those different scenarios and say, hey, if you have this credit score, this is what this would look like. If you're doing cash out versus a rate and term, we have a total cost analysis report that would compare those two options, what the differences are, so that you can understand, why this loan is a higher interest rate versus this loan.
Yeah. Also, if you're like financing a condo opposed to a single family, that's going to have some more pricing adjustments. So it all comes down to risk. Like you think about it, right? Why does a 30-year have more pricing adjustments than a 15-year? Well, because we qualify somebody and they qualified today for a 15-year. So chances are when they don't qualify anymore, they've had paid more equity into it. So it gives the bank a better position to be able to resell that home and not have a loss. Where a 30-year, they're not creating a bigger equity position as fast. So there's going to be a little bit more risk. Or like an investment property, someone is more likely to walk away from an investment property if they can't afford it because they're not living there. Where with a primary, they're less likely to do that because if they walk away from it, they're going to be homeless, right? So that's how you got to think of it, is why do rates change from one program to the next when you're talking conventional loans? And it's because of the situation. How is it affecting the investor or the bank lending the money, right?
Yes. So you would say, Brad, that the risk, it relates to the risk in defaulting, right? For somebody not being able to pay back that loan. So the bank mitigates that risk or offsets that risk based on increasing the interest rate to cover costs based on the likelihood of you not being able to pay that loan back.
Yeah. And to the common person, and myself included, I put myself in that common person box as well, even though I do mortgages for a living. It still doesn't make sense to me why you would charge somebody with more risk a higher rate, because now you're making it even more riskier for them and the likelihood of not being able to pay the debt back, right? Like you think, oh, this person's more risky, let's offer them a better payment term. That way they're more likely to pay it, right? But they don't think like that. So either way, that's what determines the rate. If you guys want to know the rate, you can Google it. I mean, that's pretty simple to find an interest rate. Where the rates are today is by Googling it, but there's not going to be an asterisk below that says this is for you, right? That's just, that's like the blanket interest rate. Every situation is different. And that's why we take an approach for everybody that's different. And we kind of show you what's available to you and what different terms or financing options make the most sense, which we'll talk about in a little bit. We're kind of wrapping it up here, but, and, moving on to talk about that, how do you know that refinancing is best for you? Craig, let's kind of like talk about that. I have a few notes here. What the process of applying for a refinance, right? So I think those two go together. right? So why don't we talk about our process to apply? And we have like a multi-step process, so it's not like a hardcore, you're not definitely applying, but you're kind of like, we're getting enough information to figure out if refinancing makes sense, and then we take the next step. So why don't we talk about, since you're running the consultation part of this, and the client facing activities, why don't we talk about the process? If somebody wanted to refinance today, and wanted to look at options, what would they do, and what would the process be?
Yeah, I feel like the first step, in finding out whether this makes sense is getting some basic information. What's the purpose behind you refinancing? Is it to lower your rate? Is it to do a cash out refinance? Is there a specific purpose that you intended to inquire about refinancing? Then it's determining whether or not there's a benefit to you for refinancing. So if you're serious about refinancing, I always ask people, if this is something you're definitely going to do, then we want to do a full application, which we have a link to our online application that we give to our clients, which is pretty easy to fill out and gather documents. This way we can not only give you a game plan for your goals, but we can determine eligibility at the same time. If you're more of just kind of window shopping in a sense, right? I'm just browsing to find out what's out there and I'm thinking about it. And you don't want to do a full application until you know it makes sense. We have a really easy process that's kind of like pre-qualifying in a sense, is that we collect 2 or 3 pieces of information from you. I would collect a copy of your mortgage statement, a copy of your homeowner's insurance declaration page, and get enough information to conduct a soft pull of your credit. We don't even have to do a traditional credit report in a sense. We can get data that shows you what your credit score is. We can price out scenarios based on your goals and come up with a game plan. And then I would send out a total cost analysis report that compares different options, for whatever it is that you're trying to do. If you want to compare your current loan, that's right now at a 30-year at a 5% interest rate, and you want to see a 30-year fixed interest rate, a 20-year fixed interest rate, and a 15-year fixed interest rate, we can show you those options side by side in that report, and we would schedule, a consultation to go over that report. So that's a quick and easy way to kind of get info without having to do a full application and get supporting documents. After you do decide that this is the right move for you, then it's, let's get the application completed and get the supporting documents and determine eligibility from that point.
Yeah, I think, and I was going to kind of chime in there on that. I think that's the biggest thing about somebody doing an application up front or not doing an application, is that we can provide you with different options, but we don't know if you qualify without getting a full application, because the income and the assets are going to help us determine that. And just like that total cost analysis, you can also compare different loans with different objectives. So you can compare, your simple rate and term versus a cash out refinance, versus, I don't know, whatever different options are available to you. So you can look at different options side by side, right?
Yeah,
and that's also showing, not just the monthly payment difference, which is what most people are focused on, but it's also showing you the 5-year and the 15-year analysis. We can even come up with different reinvestment strategies, meaning like what it would look like in terms of how much wealth you would have 15 years from now if you took what you were saving and then reinvested it, and I don't know, it's like a simple ETF or something, or maybe took that extra money you were saving and apply it back to the principal balance. Like some people will refinance for the lower rate, but then take the savings, like maybe they go down to a 15-year and they're still saving a little bit money. We can show them, okay, you're saving an extra $150. Let's apply that back to the principal. So you keep making the same payment you've always been making, and now you're going to pay it off, 2 years sooner. So your freedom point comes earlier, right? So the total cost analysis is awesome. So you're getting some documentation or some information up front, providing a total cost analysis, and then the people that say, yes, I'd like to move forward, what happens after that point, Craig?
So we're getting that application completed, collecting documents. We have an automated underwriting system. We check out your income manually. We check out your assets manually, run it through an automated underwriting software system that's used universally throughout the industry. And then at that point, we can begin the mortgage process if you're saying, yes, I agree to these terms.
Cool. And then you're probably 30 days, give or take, start to finish. And the cool thing about refinancing, this isn't a reason to do it, but there's other benefits to it. A lot of cases, you're skipping a payment. So people that apply for a refinance today, the middle of November, we would shoot for an end of December closing, and your first payment wouldn't be due until February. So you essentially don't have a payment due in January. In some cases, we can even structure it where you skip two. So again, those are not reasons to refinance. It's just another added benefit because let's face it, going into the holidays, we can all use a month off of the mortgage, right? So, cool. So, is there?
Yeah, I just want to add, Brad, to all of this. Doing the cost analysis, doing the eligibility check to see whether it's likelihood that you'll qualify for a refinance. This doesn't cost you any money. This is just time in a sense. And we go through all the legwork and put together this stuff for you to determine whether there's a benefit. And there is no obligation to get this information. So it's, it just takes you time. We will evaluate and give you, a professional consultation and go over this stuff to determine whether this is going to make sense for you, but at no cost. So you will only pay a fee for a refinance if you settle. The only additional cost is if you decide to move forward and we need an appraisal, that would be the only out-of-pocket expense that you would pay for doing a refinance.
And that's another good thing that you brought up. A good point is the appraisal. A lot of times when you're doing just a rate and term refinance in today's market, we're getting a thing called an appraisal waiver. So we've refinanced a lot of people where an appraisal was not required. And the best thing about it is we've actually refinanced people and removed mortgage insurance, which is another thing that we kind of missed. That's another reason to refinance is to get a lower rate, or even if you get a rate that's equivalent to what you currently have, but you have the ability to remove mortgage insurance, that's a benefit. That's a reason to refinance. So we've done that for a lot of people where we didn't need an appraisal and the system accepted the higher value that we put in there. And now we refinance people and got rid of their mortgage insurance. So definitely no cost to finding out, guys. Ways to find out what do you do next? It's either reach out to either Craig or myself, or if you know my wife, send her a message because she's a part of the team. I'm sure she's going to share this video. You can use the links provided. There's a refinance rate checker, or if you're looking to purchase a home, Tanya Bettis, if you're still on here with us, I did see your message and I will respond after the live presentation's over. Hopefully we can connect. But there is also a purchase qualifier link in this below. So you can also find out if you guys qualify for a purchase, because although we're talking about refinances today, we have helped a lot of people purchase homes as well. That's where we do most of our business. So either use one of those links or feel free to reach out to us, DM us here on Facebook or YouTube or wherever you're watching this live feed. Or you can email myloanteam@acremortgage.com. Or call us or call 866-416-7156. Guys, I hope this information was helpful. That's all we're doing here is trying to provide value, share strategies, tips, just things that could help you navigate the mortgage process. Craig, I'm going to leave it to you. Anything that you'd like to add?
Yeah, and if anybody ever needs anything, they can reach out to us via Facebook or that number that you gave, Brad. But yeah, I'm glad that we're able to help people, and check us out every Wednesday. We're going to be here to give as much knowledge as we know and what we can to help people make good decisions financially.
Awesome, man. Well, Craig, thanks as always for your time. I know you're busy doing consultations all day, so thanks for making time for us.
No problem.
All right, guys, have an awesome day. Thanks again for watching. Talk to everybody soon.
Happy Wednesday.
Happy Wednesday.